Lesson number 2, borrowing crypto with Compound. Typically, in order to take out a loan, Maya would have to fill out an application with a centralized financial service provider. It's a long process with a host of requirements and opportunities for bias. To avoid this, Maya could borrow crypto assets directly from Compound instead, using assets she has supplied to the protocol as collateral. In traditional finance, this process of borrowing against supplied assets is called over-collateralized lending. Compound is different from a typical money market, though, because it's decentralized and operates completely autonomously. The only central authority is the code itself. With Compound, Maya, or any financial application or service, can instantly access borrowed crypto assets and then make use of them however they see fit. For example, Maya's goal might be to put an advanced trading strategy into place, like leveraging her borrowed crypto to invest in other assets. To borrow crypto, the first thing Maya does is supply an asset to Compound. Supplied assets immediately start generating interest and can also be used as collateral to borrow any other supported asset of Maya's choice. The more she supplies, the higher her borrowing limit increases. To limit risk across the protocol, Compound gives each asset its own unique collateral factor. This means that each supplied asset will affect the borrowing limit differently. For example, for every $1 of ETH Maya supplies, she can borrow up to 75 cents worth of USD coin. This is because ETH's collateral factor is 75%. Maya earns interest on any assets she supplies, even while they are being used as collateral. This helps to lower the cost of borrowing, as the net cost to borrow can be seen as the borrow rate minus the interest being earned on supplied assets. The interest rate for each Compound market is dynamic and based purely on supply and demand. These rates determine the interest Maya pays for borrowing an asset and are calculated per block, just like when earning interest. This is done to ensure the rates always reflect current market conditions. Over time, markets with fewer suppliers and lots of borrowers will become more expensive to borrow from and more rewarding to supply to, while markets with lots of suppliers and fewer borrowers will become cheaper to borrow from and less rewarding to supply to. In essence, the more an asset is borrowed, the higher the interest rate will rise, and vice versa. With Compound, Maya can save time and borrow crypto instantly, without having to liquidate her other crypto assets, provide her credit score, fill out an application, or wait for an underwriter's decision.